Welcome to Yadnya Investment Academy. Here comes another term in the series of terms you should be familiar with so as to read the performance of various funds. In our earlier videos, we have studied about standard deviation in one of them, and in another video, we have studied alpha and beta. And in this video, we are going to talk about Sharpe ratio. Standard deviation value of a fund tells us the amount by which the returns may go up or down in correlation with its mean or average returns. The beta value of a fund tells us how closely is the fund correlated with the index it follows, and hence you could predict returns of the fund whenever the markets move up or down. And an alpha generated by a fund tells us the amount of returns generated by the fund over and above the ones predicted by its beta value. Now let us move ahead and understand what is Sharpe ratio. It is always assumed that better returns mean good investments, but some investments that are too risky might at times produce very good returns, and looking at such returns, you may fall for those investments. It is always better to go for investments that give you good amount of returns but with optimal risk taken. Now, how to differentiate between investments that are too risky and the ones that give you good amount of returns with optimal risk taken? Well, the answer is Sharpe ratio. Sharpe ratio evaluates risk and returns together to help you choose an investment that generates higher returns but for optimal risk taken. Mathematically, Sharpe ratio is represented as average returns offered by the portfolio, that's nothing but your mutual fund, minus returns offered by a risk-free investment divided by standard deviation. Now let us look at the numerator and denominator separately. Average returns of a fund minus returns generated by a risk-free investment gives us returns generated by the fund by taking risk. Investments like government bonds, treasury bills, etc. are considered to be risk-free investments, and so returns of such investments are taken for calculation of Sharpe ratio. Now, a fund's returns may move up or down based upon the risk the fund has taken, and standard deviation straightaway gives this value, and so it is considered to be the denominator while calculating Sharpe ratio. So putting the numerator and denominator together tells us that Sharpe ratio is nothing but returns generated per unit of risk taken. Let us take an example to see how Sharpe ratio is calculated. Let us assume there is a fund A which has an average returns of about 36% and standard deviation of 20. Returns of a government bond is 8%. So the Sharpe ratio would come to 1.4. Now, if we compare this fund A with another fund B with a Sharpe ratio of 1.7, where both these funds fall in the same fund category, and let's take an hypothetical case where alpha, beta, standard deviation and mean values of these funds are almost equal. So the Sharpe ratios indicate here that the fund B is taking way lesser risk as compared to fund A to generate same amount of returns. Sharpe ratio is a single figure and it is only useful when you compare funds or compare a fund with its benchmark. Sharpe ratio also helps a fund manager evaluate whether adding an asset is doing any good to the returns of the portfolio. It is assumed the higher the Sharpe ratio, the better it is, but at times the Sharpe ratio may be higher due to lower standard deviation, that is lower denominator. So either you'll have to check how the Sharpe ratio is being calculated or look at Sharpe ratio along with other parameters like alpha, beta, standard deviation, mean, etc. to get a clearer picture of the returns generated by a fund. Now we have been repeating this over and again. The different fund fact sheets and various investment websites may show different figures of Sharpe ratio and other parameters as the time frame considered and the frequency of calculation may vary. So the next time you compare funds, take data from a single source to keep things simple. Friends, hope you have some idea about Sharpe ratio now. This far we have studied standard deviation, alpha, beta and Sharpe ratio. In another video, we'll see how these figures are used together when you compare funds. Friends, thanks for watching this video. Watch this space for more such topics. Until then, happy investing.